So, hello everybody. I hope everybody's having a good morning if you're up already. All right, so this is I want to make a video for chapter 5, which we went over in class Tuesday. And most of all, it was with regard to ratios, as you know. And sometimes not the most exciting topic, but nevertheless, we have to cover it in class. Okay, so there's different stages in a project, as we all know at this point, and here's the financial ratios that your book associates with each stage. Not necessarily my opinion, but where you get cash from and the type of financing depending on the stage. So just remember, you should know the different stages for your midterm. I mean, there's a lot of definitions in this book, and you should know them. All right, so we're going to talk about financial ratios, and as I said in class, right, you can trend your own financial ratios over several years or periods to determine how well your company is doing or how bad it's doing, right? And also there's a cross-sectional analysis. And how do they define that? You're just comparing yourself against another firm. So that would be like Amazon comparing themselves to Walmart, right? They're both doing online shopping, right? At the same point in time. All right. So the third one that they show is industry comparables, right? And here you are comparing yourself against the overall industry. The overall industry has an average, and you can get these averages and all these ratios from your library. They have good databases there in Melville. All right, so here's a sample income statement, which we talked about, and you notice it's 2 years, right? 2015, 2016. They start out all the time with net sales and go down to net income. And here's the associated balance sheet. This they show you for 3 years. And the statement of cash flows, again, for 2 years. There's 3 components, as we talked about in class, right? Operating, investing, and financing for a statement of cash flows. Okay, so cash burn is how quickly you're going through the cash to pay your expenses, right? So cash, a venture expends on its operating and financing expenses and its investment in assets. And this is something you could determine, right? So here's a cash burn for a fixed period of time, right? Otherwise known as cash burn rate. So if you had this number here for the year and divided it by 12, right? You'd say, okay, I'm burning, let's say $1,000 or $100,000 a month. So that's my rate per time period, month, year, All right, so here's the equation. And we went over this equation in class. And this is a real important equation here. It tells you your cash burn. And there's a lot of components. And it's inventory, admin expenses, marketing expenses, R&D expenses, interest expenses, change in prepaid expenses, change in accrued liability, change in payables. You subtract this guy off. Just make a note of that. Plus capital investment and taxes. Now, I want to make a point here. For all you people who are doing this online, this is an important equation. And make sure you go over the example and you understand how to use this equation and where you get the information from. Because most likely we'll be going over this on the midterm, all right? And here's the numbers that they pluck off. You should understand where these numbers come from, all right? And this is what they pluck off in the sample sheets I just showed you, going back, 2 or 3 slides. So this is also in your book. So this is all, broken down in your book, okay? So you should, be aware of... you should be aware of this. So this is all broken down in your book. But it's an important equation. And the next equation is cash build. If you're not burning it, you may be building it, and that's a real simple equation. It's net sales minus the change in receivables. So cash build is right. So your cash build rate again would be just divided by, like, let's say if it was a year, you would divide it by 12 and get the cash build per month, right? So in this example here, if you looked at the how they calculated a cash build, you will notice that the cash burn is greater than the cash build. So if you subtract it here, you'll get the net cash burn, right? And so obviously they're burning cash quicker than they're building it, which is not a good situation, right? You got to probably borrow money short term from a bank or something like that. All right, so now we start with the ratios, and the first class is the liquidity ratios, right? And you've probably seen this in 330. The current ratio is the average current assets of the average current liabilities. Now you'll notice in this book, I don't know if you remember from 330, but they divide by 2 here, right? So they're dividing by 2. They're taking an average over 2 years, and you get the you get the current ratio. Again, these are all in your book, and you should be able to please read these chapters for the midterm. All right, so the quick ratio is very similar to the current ratio, except they realize that it's hard to get rid of inventories. So they said, well, let's take the inventories off because we want to get rid of the inventories. We're not going to be able to, get rid of those so quickly. So you can see what happens. Let me go back for a minute. You can see what happens. Here's the current ratio, 1.37. So what they're basically saying is for every dollar in liabilities I have $1.37 in assets. So I can pretty much, I can cover my liabilities. So I'm not in a problem there. And, it becomes 0.62 when you subtract off the inventories. Everyone see that? So that becomes a problem. So, inventories are not something sometimes that you can easily get rid of, right? All right. So, the next thing is net working capital, and that's simply current assets minus the current liabilities. That you simply subtract that. And there's a ratio called net working capital, which you just see right up here, right, to total asset ratio. And you see you take the subtraction, which we talked about right here, right? See this right here? And divide that by your total assets. And basically, you have the difference. So you have enough total assets, net working capital to that's being generated, to cover your total assets here. And you see they do the math right here. Right? All right, so here's an example. Here's the just a box that shows you the ratios and stuff that we calculated so far. So once again, you should go through each of these numbers and see what they mean. So you can see from year to year, there's 189,000 change in cash burn, right? So that's simply 45.3%, right? So you should be able to understand the math behind how they get these all the numbers here. All right, so the next class of ratios is the leverage ratio, and basically we'll go through some of those. And it's leverage ratios talk about debt. How much debt do I have, right? Am I leave it out? Do I have a lot of debt? If I have like a $2 million mortgage, I maybe leave it out. All right, loan principal amount needs no explanation. You take a student loan or a car loan or a mortgage. That's how much you borrow. And the interest is how much you're going to pay, to rent this money here, right? Interest is like rent, right? You got to pay it, so. All right, so the total debt to asset ratio. This ratio is basically telling you here how much debt you have compared to your total assets. Now, you don't want to have too much debt compared to your total assets, right? So that may, a lot of companies have a lot of debt these days. So, that's not something you want to have too much of. And again, they go through the numbers nicely here. So you should see where they get these numbers from. And, it'll be what you should, you should go through here. All right. So, we're about, this is a 10-minute video. So I think I'm like halfway through the slides. I'll make another one later on. So, we'll knock off here. This way you have 10-minute bites. Alrighty. I'll talk to you later. Everybody have a safe weekend.